Hi there, Dan Kurz, DK Analytics. Thank you for tuning in. It is Saturday afternoon, May 9th, 2020. I'm chiming back in with a video that I've titled A Wider Than Ever Gap Between Bubble Assets and the Underlying Economy. Some brief valuation metrics. The US dollar index, DXY, stood at 99.10 on Friday. All these numbers are Friday-based closing numbers. Down a bit. The Fed's balance sheet reached a record level, $6.7 trillion, up but slowing its increase for the moment. The US 10-year Treasury, the yield stood at 0.68%, kind of treading water. The S&P 500 reached 2930. I'll get to that in a second. Oil reached $24.74 per blue barrel. That's the WTI oil price. So we're back into positive numbers, and gold in the meantime closed Friday at $1,713 per troy ounce, and silver closed at $15.78 per troy ounce. The S&P had the best month in April since 1987. That is the best monthly performance since 1987. I believe the best April since 1938. And this despite an economy falling off the proverbial cliff. Let me go through some recent data to underline my title and to take it from there. The Q1, the first quarter, year over year, U.S. real GDP growth, the first estimate, was a contraction of 4.8%. Revisions will likely make this contraction reach 7% or higher. Q2, year over year, real U.S. GDP could contract by nearly 40%, loosely shadowing similar PMI cliff dives in both the services and manufacturing arenas, a halving of auto purchases, and a 40-ish% reduction in oil use that are all manifesting themselves so far in the second quarter, year over year. By the way, PMI data falling off the cliff in both services and production is largely a global phenomenon that is continuing, with a few exceptions, such as in Asia. Recall that the huge decline in oil and gas prices is, and already has, and is continuing to devastate the fracking / shale oil industry, natural gas industry, which had been a bedrock of heartland American industrial and manufacturing strength, given the enormously capital, chemical, engineering, labor, and trucking intensive nature of this undertaking, which also generated lots of good to high paying jobs. More data. April non-farm payroll employment fell by a record 20.5 million in April in the United States, as the government unemployment rate soared to 14.7%, the worst monthly job destruction tally since the government started to record this back in 1948. By the way, unemployment as measured by 80s standards would currently be at an unparalleled 35%, according to John Williams' Shadow Stats site. Meanwhile, over 33 million Americans have filed for unemployment benefits during the last 7 weeks alone. Talk about a tragedy. Also, U.S. federal debt just recently topped $25 trillion, up nearly $2 trillion since year-end at 2019. In fact, up almost $1 trillion in just a month, right? And the 4 months since the beginning of this new year have a debt to GDP as a result of this huge increase of $2 trillion in a bit over 4 months. The debt to GDP, the federal government debt to GDP, better said, is at 119%. That is federal debt to GDP, US GDP, 119%. Note that it took over 200 years for US federal debt to reach $1 trillion. With US federal debt expanding at a $6 trillion annual rate, and the economy about to shrink even more drastically, we could soon see a federal debt to GDP ratio of 160% or more in the US. Economies are known to get into growth trouble when this ratio exceeds the federal debt or the government debt to GDP. In the US, in fact, there's $3 to $4 trillion in state and local debt that we could throw into this. It would make it even worse. But let's just stay for the moment, for the sake of ease, with the federal debt to GDP. If in other countries this has exceeded 95%, then those economies have gotten into trouble. They have also had to pay much higher interest rates for borrowing money from overseas. Now, self-financing countries for decades had high domestic savings rates, such as for a long time Italy and for a long time Japan. They could afford to finance the deficits domestically, but the U.S. can't, and is the world's largest debtor. So the U.S. ride going forward here as debt to GDP goes way up and America needs incredibly dependent upon foreign financing and has some $10.5 trillion in foreign debt growing at roughly $600 billion a year. That might not be so easy to sustain the currently record low U.S. interest rates. Some more statistics. Roughly 33% of all public U.S. corporations have been estimated to be zombie firms. That is, unable, or firms rather, with just enough cash flow to sustain operations and to pay interest on outstanding debt, but not enough to necessarily be profitable, much less repay debt or invest in product portfolio competitiveness. Meanwhile, another statistic or two. The Federal Reserve's balance sheet has expanded by 61% since the end of 2019 to $6.7 trillion, as I said, while the M1 money supply over the same period is up by a stunning 23%. Over 4 months, in essence, to $4.9 trillion, and M2, the broader money supply number, is up 15% to $17.6 trillion. Again, juxtapose those surging money supply numbers against an economy which is crumbling. Now, I'm going to take a look at what I call coronavirus response supply killers and coronavirus response demand killers and coronavirus response price related considerations or developments. And I say this because, and in contrast to some other pundits who say that, well, The coronavirus response is just the needle that pricked the bubble of complacency and asset valuations, which have been reinflating. And I disagree strongly. I think this is the brick wall that the economy ran into. So I don't think it's a straw that broke our bubble economy's back. I think it's a bridge that fell on the camel. So I beg to differ with all due respect, because you cannot carry forward an economy by shutting it down. There's never been a shock like this, and there's never been a virus response like this, and a very unjustifiable one, but I'll get into that and already have. In later video or two, I'll double down on that. In any event, what are the coronavirus response supply killers? And when I say that, I attribute that mainly to the policymakers' lockdowns, shutdowns, quarantines, shelter at home, and all this other nonsense that is in essence contributing to just gutting supply, even for people that can't even show up at work or long couldn't, despite the current opening that is in the offing in various places. What are the supply killers related to the coronavirus response? And many of them will linger, I'm afraid, and can't be quickly reversed. Well, we've got huge supply chain shocks that are still reverberating. In general terms, that is true. We've got meaning that we're going to have a sustained period where parts are difficult to come by and products are difficult to pull together, from food to manufactured goods, given a global dependency on supplies from various corners, from China and elsewhere. I mentioned in 2-3 videos ago that U.S. pharmaceuticals were about 90% Chinese-based, or at least the key ingredients, as a very stout example of the global supply chain dependency. What else? What other coronavirus response supply killers? And I'm setting this up as such. We've got supply killers and demand killers related to this virus response that are, I'm going to say, going to make what amounts to bubble assets look even bubblier and even more disconnected from economic and financial reality. We've got in the US and elsewhere sustained, utterly unconstitutional lockdowns and quarantines in various states that are continuing. And those same states are typically run by power-hungry leftist governors, such as in New York State, in Illinois, and in California. More on that topic in a video to come. What else? Millions of Main Street businesses are downsizing, filing for bankruptcy, and are outright closing, from bars to restaurants to farms to repair shops to retail shops. Hard-pressed airlines having to keep between 1/3 and half of the plane empty. Social distancing, don't you know? In a hugely expensive, hugely high fixed cost structure, hugely leveraged balance sheet business, that's devastating. The same holds true for the cruise industry and for the hotel industry. Meanwhile, the auto industry, component suppliers, housing industry, construction suppliers, the medical/healthcare sector, and last but not least, the all-important domestic energy industry, where both geology and finance suggest a huge downsizing of permanent nature, will all be downsized materially. All those sectors will be downsized materially. Plus, expect lots of productivity killing, restrictive regulations to be piled on top of social distancing and mask wearing. Also, expect ambulance-chasing lawyers wielding contingency fee lawsuits ready to sue businesses frequented by a coronavirus sick plaintiff to skyrocket Contingency fee lawsuits, obviously the lawyer finds someone that's sick and tells them, look, I'll sue on your behalf. It won't cost you a dime. If I win, then I keep 30% of the settlement, right? What's all this amount to? More supply shrinkage and really ugly stuff to boot. Well, so much for supply killers. And this is just the tip of an iceberg, as you can imagine. What about the coronavirus response demand killers? Virus fear demagoguery, first and foremost. Well, perhaps at least first, foremost I'll get to. Speaking of I'll get to, I will get into the actual death rate or revisit it for the broad population as more and more data comes in once more, which will point to vehicular death kind of risks. That is, the risk for the average person to die of the coronavirus is similar to an average person's risk of dying when he gets into a vehicle or a car. Or said differently, something around or actually below 0.1% of those in the general population, the overall population, that get infected with this virus. However, after seeing months and months of coronavirus deaths on CBS, NBC, ABC, and CNN, and the German equivalents, ARD and ZDF, and I forgot what they are in Switzerland, and I'm sure elsewhere. All this propaganda making it look like we have the Spanish flu revisited in terms of fatality rates. Lots of people, perhaps most people, are going to adopt a wait-and-see attitude before returning to prior shopping and dining out habits. Social distancing and having to wear masks, another demand killer. Who wants to go to the movies? Too hot and humid Disney World when you can't hug Mickey Mouse as a kid, and while you have to wear a mask in hot, humid climate all day. Having to wear masks and keeping 6 feet away from others in all kinds of establishments, from restaurants to Disney World when it reopens, to airplanes, to house hunting or car purchases. Who wants to deal with it? Especially if jobs lost are being lost at absolutely unprecedented levels with unprecedented speed, while consumers' balance sheets are already typically weak, featuring little savings and considerable debt. More demand killers. I'd say the biggest one of all. Jobs, bubble economy jobs, all right? Highly indebted economy jobs, and coronavirus specific job losses will in aggregate likely be the biggest sustained killers of all in terms of demand. And shrinkage in higher wage, shale and gas jobs to reduced higher wage manufacturing jobs, to reduced service sector jobs, from the low wage retail sector to the higher wage medical / healthcare sector jobs, to many so-called professional jobs such as accountants, lawyers, doctors, engineers, etc. These will all throttle or crush demand. For flavor of likely continuing attractions here, consider some U.S. April job loss statistics. The healthcare industry lost over 1 million jobs, again, just in the month of April. Retail lost 2.1 million jobs. White collar / professional arena lost 2.1 million jobs. And manufacturing lost 1.3 million jobs for the second month in a row. Not exactly demand positive. In aggregate, productivity will also likely decline even more sharply from a multi-decade erosion in output per man hour towards zero or below zero from about 2% 2 decades ago. We've been drifting lower and lower. This sustained, and I'm going to say accelerated productivity collapse will be related to downsizing initiatives and to even more red tape, courtesy of the coronavirus response and to litigation fears. Look for negative productivity lasting longer than usual in a recession/depression that will likely also prove longer than usual. I dare say likely much longer. That very fact will weigh on earnings power, on standards of living, and on economic growth. If all this sounds theoretical, think about how much more complicated and how much longer virtually everything takes in coronavirus response land. From banking to booking an airplane ticket. I spent the better part of 3 days trying to get something done on Delta, by the way. To getting a car parked, it's been 2 weeks. To ordering food when you're going out to eat, ultimately you give up. And if this takes the consumer that much longer, the flip side is that it also takes the businesses providing the product or service that much longer. How does one spell going backwards or an unwealth of nations trajectory? Now, let me turn to the coronavirus response, goods and services price impact. With much lower virus response-induced capacity utilization, a lower global supply of goods and services, and with productivity heading south, businesses will have to charge higher prices, or in some cases, happy ones, they'll be able to charge higher prices, the survivors, right, due to peers having gone out of business. Those consumers that still have the guts or the money to consume will likely face rising prices of goods and services, something which global central bank counterfeiting, now kicking into even higher gear, will make worse still. The proverbial too much currency chasing too few goods and services. Remember that inflation is too much currency created relative to real GDP growth, another way of saying it. Think about US M1 money supply rising by 23% in just 4 months, just as the economy is set to fall off the cliff. Or think about the wellspring of now rapidly rising money supply. Central banks' monetary base, or central banks' balance sheets. They say a picture is worth 1,000 words, and a few scribbles, I hope. Take a look at this as I bring this onto the camera. And I apologize for the less than optimal quality of this picture once again. But look at what this says. What this says is, let's see, I think I got it. There we go. Cumulative central bank balance sheets. That is the heavies, right? From America to China to the ECB to the Bank of England to Bank of Japan to Switzerland. But what we see is from 08, right over here, from about 6 trillion, all these central bank balance sheets put together, we've gone as of April 2020 to 24 trillion, right? Or 4 times the 08 or 2008 level, which amounts to a compound annual growth rate of 12%, which easily outstrips by a magnitude of 4 to 5 times global real GDP growth rate during or over the same period. All right? I hope that was readable, or viewable, I think is the right word. Plus, once corporate treasurers and consumers alike realize that goods and services are getting more expensive, they will go from waiting for cheaper prices to buying now before it goes up, thereby also stoking higher inventory levels while throwing just-in-time inventory practices due to supply chain disruption risks overboard, increasing demand for parts, components, and finished goods, causing even more of central bank balance sheet bloat to reach the money supply in the process, thanks to the associated money multiplier levitation. Against this depressionary, ultimately stagflationary backdrop, with EPS, earnings per share residuals, set to implode into mere stubs of the recent high watermark levels, or into outright and steep losses, the S&P 500 is currently trading at over 23 times trailing 12-month GAAP earnings per share. The earnings per share as of the Q1 period, the latest 4 quarters on record, are $125.55 per S&P 500 share, right? Trading currently at 23 times that, the PE. If EPS crashed by just 50%, at today's S&P 500 level, the PE would balloon to 47. If EPS imploded by 75%, which I think is a much more likely occurrence, also given past trends that I've gone over from 06 to 09 and how long it took to get back to peak earnings, 5 years. But if earnings collapse by a similar magnitude as they did from 06 to 08, 09, the 75% reduction in earnings per share of the S&P is not impossible. In fact, it's likely, given that we're in an even much worse place than we were in 08, 09. And that EPS collapse, juxtaposed against the current S&P of 2930, would yield a PE of a whopping 93. When one considers that EPS, in addition to all that, are likely to remain depressed for potentially a long time for the reasons I have reviewed many times, including leverage bottom line declines in periods of economic contraction and lingering weakness, the S&P 500 stock market bubble looks even riskier. The reason for the bubble valuations in stocks and bonds, as you know, is the huge printing press induced wealth transfer to Wall Street and K Street, from Goldman Sachs to Boeing to Delta, which has rekindled stock enthusiasm on the one hand while keeping bond yields depressed on the other hand, including in junk bond land, given the Fed's readiness to further bastardize its initial non-monetization charter and to even buy junk bonds if necessary. That is, on top of bailing out Wall Street repo rate explosions. This Fed put and other central bank puts are allowing the likes of leading hedge and private equity funds, as well as troubled Boeing and GE and other buyback/corporate anorexia queens, to refinance what otherwise wouldn't have been affordable, much less available, that is, the funding, which would have totally dried up because we would have had not only liquidity, but a solvency crisis, which is currently being papered over via massive future inflation. In aggregate, and as reflected by the Fed's $2.8 trillion balance sheet expansion, as well as the U.S. federal government's $5.8 trillion debt bloat increase in debt over the past year alone, the current statist/fascist rescue scheme is making the S&L bailout of the 90s and the TARP bailout of 08-09 look like pikers in comparison already, and we're likely just getting started. Investors and people generally don't seem to appreciate or understand that you can't print value creation or wealth. You can only print redistribution to takers and to the elite, Wall Street and K Street, and to the politicians and bureaucrats they are in bed with, and the trial lawyers as well. That elitist redistribution eventually morphs from asset inflation to goods and services inflation for Main Street. We're closer than ever to Main Street inflation really taking off to an even higher level, and a dollar swoon would only accelerate our ride into stagflation here in the United States. In a related sense, investors and people generally also don't seem to appreciate the extent of the economic weakness that we are entering. Economic weakness, given our unparalleled global and U.S. indebtedness, that could well turn out to be a lasting depression that could rival the Great Depression, if not eclipse it. Socialism doesn't work. It goes against human nature. It just makes things worse for most people, especially if you can print the money to finance it and redistribute it away from Main Street makers. In contrast to the Great Depression from 1929 to 1939, this time around, as we all know, we have much higher U.S. and global debt to GDP levels, both government and private sector, much more money printing, and much more status/crony misallocations, and obviously much worse productivity. That's what we get. In plain English, many stocks, and most especially bonds at the zero bound, around the world remain horribly overpriced, particularly when juxtaposed against what will likely be a record and lasting decline in corporate profitability on the one hand, and much greater insolvency and monetary inflation risks on the other hand. Therefore, and I know I sound like a record with a skip in it, but use the central bank's bubble reinflation currently ongoing, which I predicted in both March and April were likely to happen, as a fleeting gift to reduce exposure for investors that bought the assets at elevated prices. That is, for anybody other than investors that bought assets at very cheap valuations compared to normalized earnings power, which typically means you purchased blue chip stocks or good income generating property decades ago and can ride this out. In retrospect, does the titles or the video's title of a record gap between bubble assets and the underlying economy make sense? I sure hope so. In any event, I hope you found my musings worthy of your time, worthy food for thought. More on related themes, especially in the policy, property right protections, price discovery, rule of law, and civil liberty realms, which are all essential aspects of a well-functioning free market capitalist system. That is, if they are constructive instead of destructive. Sadly, we're going from bad to worse here, with the coronavirus response just the latest and so far greatest body blow to what's left of free market capitalism and codified freedom. I should be back with my 2 bits on such matters and a couple helpings, if you will, in the not too distant future. Thanks a lot for tuning in. over and out here from Bonita Springs on May 9th, 2020. Bye-bye.